So, when a high-flying tech stock plummets like 20% in just 5 trading days, what exactly are you looking at?
Well, that's the ultimate question, isn't it?
Right. I mean, is that a flashing neon-strong sell signal warning you to just get out while you still can? Or are you staring at the ultimate once-in-a-decade undervalued buying opportunity?
Well, it's the classic Wall Street staring contest. You have this incredibly ambitious company running headfirst into the brutal realities of, you know, physics and finance, and the market is just frantically trying to figure out which force is going to break first.
Exactly. Welcome to today's deep dive. Today is April 20, 2026, and if you've been watching the ticker for AST SpaceMobile, that's ticker symbol ASTS, you know it has been an absolute roller coaster.
Oh, an absolute wild ride.
Yeah. But before we get into all the details, make sure you like the video and subscribe to our YouTube channel, and you definitely have to leave us your comments and feedback down below. It's compulsory, guys. We want to hear your thoughts on this stock.
We really do. The debate on this one is just fascinating.
It really is. So we are jumping straight into the breaking news today. ASTS shares took a massive hit. We're talking about a nosedive of about 13% intraday, finally clawing its way back to close down 5.30% at exactly $81 flat. And the catalyst for all this panic, a Blue Origin rocket failed to correctly deploy a Bluebird satellite.
Which, in the space economy, that is a highly visible, highly expensive public failure. It's basically the aerospace equivalent of a shipping conglomerate watching their newest cargo ship sink right outside the harbor.
Well, the investors are just watching from the shoreline.
Exactly. And it has the market completely spooked right now.
For sure. So our mission for you today is to unpack the financials, decode the underlying technical signals, and really examine the fierce Wall Street debate going on right now. We need to figure out if this is just a temporary hiccup on the way to the stars or if it's, a classic value trap.
And just to lay the ground rules right up front, this is purely an analytical debate of the data. We are exploring the mechanics of the market. We are not giving you financial advice.
Right. Definitely not financial advice.
It's a vital distinction to make, especially in the space sector. You're dealing with companies that trade almost entirely on future promises, which makes the present reality incredibly volatile.
Totally. So let's start by assessing the blunt force damage from this Blue Origin deployment failure. Because before we can diagnose the underlying health of the company, we really need to understand the immediate psychology of the traders reacting to this news.
Yeah, the current price action is always your best window into the market's collective anxiety.
And there is a lot of anxiety. We closed today at $81, but the intraday volatility was wild. The day's range saw the price drop as low as $73.50 before bouncing back up. But to really grasp the whiplash here, you have to understand the scale of the past 12 months.
Whoa, the 52-week context is wild.
It's insane. Just a few months ago, in January of 2026, this stock was riding a wave of sheer euphoria, hitting a high of almost $130. But a year ago today, it was sitting down in the mud at roughly $20.
So we're looking at a stock that multiplied its value by 6 in less than a year and is now rapidly retreating from those euphoric highs.
Right. And looking at the market structure today, the data shows narrow liquidity but very active selling pressure. The bid is sitting at $80.75, and the ask is at $81.27. And the trend is strongly bearish, down 20% over the last 5 days since the rumors of the deployment issue first started swirling.
Yeah, the rumor mill really did a number on the momentum.
It did. But I want to pause and challenge the prevailing narrative here for a second. A 20% drop sounds terrifying on a Tuesday, sure. But considering it was trading at $20 a year ago, isn't it entirely possible we're just seeing normal turbulence? Like, are retail traders just getting shaken out by a single bad headline? Or is there a structural breakdown happening here?
Well, it's really tempting to write this off as retail panic, but when you look at how the market makers are handling the order flow, a very different picture emerges. Consider that narrow bid-ask spread you just mentioned. It's just about 50 cents between the buyers at $80.75 and the sellers at $81.27. In a healthy, upward-trending market, buyers are usually willing to step up and pay that higher ask price because they believe the stock is going higher.
But that isn't happening right now.
Far from it. What we are seeing is sellers aggressively hitting the lower bid price. They're not waiting around to negotiate a premium. They want out. And they're willing to take a haircut to ensure their order gets filled immediately.
Wow, okay.
And that sustained, deliberate pressure is exactly why that $73.50 support level was tested so hard today. active participants are systematically de-risking their portfolios.
So it's less of a chaotic screaming panic and more of a calculated exit strategy for some of these holders.
Yeah, it's exactly the read on the tape. A 20% drop might look like a blip if you're only looking at the 5-year chart. But
Oh.
to institutional algorithms and short-term fund managers, that kind of selling pressure is a structural warning sign.
Okay, so if the market is systematically de-risking, we need to figure out what they are so afraid of. The deployment failure is the spark, obviously, but the fuel for this panic has to be sitting on the company's balance sheet. So let's look under the hood at their 2025 financials.
This is where you separate the visionary pitch deck from the cold, hard operational reality.
And the reality here is intense. AST SpaceMobile is a classic, high-growth, pre-revenue-heavy firm. Looking at their full year 2025 income statement, I mean, revenue is up an explosive 1,505% year over year.
Which sounds amazing.
Right. They brought in just under $71 million. That sounds like an incredible proof of concept for their technology. But then you look at the bottom line, and the net loss is a staggering $342 million.
The scale of that burn rate is astronomical.
To put that in perspective for you guys listening, they are spending almost $5 for every $1 they bring in. And then you look at the balance sheet. They have total assets of about $5 billion, weighed against liabilities of $2.6 billion. That leaves them with a working capital position of roughly $2.3 billion.
Which is a solid cushion, on paper.
On paper, yeah. So I'm looking at this and thinking of it like a giant aerospace fuel tank. They have $2.3 billion in working capital to burn, but they are burning it like a literal rocket engine just to get these initial satellites into orbit. The revenue growth is a nice spark, but they are deep in the red.
The fuel tank concept is the perfect way to understand their runway. And it directly explains why the market reacted so violently to the Blue Origin misfire.
Because a lost satellite isn't just a delayed schedule, right? It's a massive hole in the fuel tank.
Exactly. Think about the mechanics of how a company like this operates. They have deeply negative operating cash flow. So every single dollar of that $2.3 billion working capital has to yield a tangible return in orbit.
It has to actually do something up there.
Right. When a deployment fails, it's not just a piece of highly engineered metal floating uselessly in space.
Yeah.
That satellite represents capitalized cash. It represents millions of dollars in research, development, materials, and launch fees that have just suddenly evaporated.
Wow. And the only way to replace it is to dip back into that finite fuel tank.
Which accelerates the timeline for when the tank hits zero. The market gets spooked because a lost satellite means the company might have to go back to the capital markets way sooner than expected to raise more money.
And raising capital when your stock is dropping is a total nightmare scenario for current shareholders.
It creates a vicious cycle. If you need cash, you have to issue new shares. Issuing new shares dilutes the value of all the existing shares. So investors start selling today because they're anticipating that their slice of the pie is going to get forcibly shrunk tomorrow.
So the math of corporate survival just gets significantly harder with every single operational failure.
Exactly.
Okay, so we've established this incredibly precarious fundamental picture. Massive cash burn, undeniable revenue growth, all underscored by extreme operational risk. Let's pivot and look at how the trading algorithms are digesting all of this tension. We need to examine the technical breakdown.
Yeah, technical indicators give us a map of the market's immediate momentum. They strip away the narrative and just look at the math of human behavior.
And right now, that behavior looks incredibly bearish. The charts are showing the formation of a falling channel. The moving averages are flashing a strong sell across the board because the price has sliced completely below its short-term averages.
It's a pretty ugly chart today.
It really is. Immediate support is at that intraday low of $73.50. But what really caught my eye is the 14-day relative strength index, the RSI, which is sitting right around 41.68. And here is where I see a massive contradiction.
Oh, the sentiment clash.
Yes, roughly 90% of these technical signals are screaming bearish, but if you look at broader market sentiment tools like the Fear and Greed Index, it remains firmly neutral, sitting dead center at 50.
That divergence is one of the most revealing data points we've looked at today.
I'm really struggling to reconcile it. How can 90% of the technical math show a stock in free fall, while broader sentiment is just shrugging its shoulders at a casual neutral 50? It feels like the charts are bleeding out while the paramedics are taking a coffee break.
That's a great image.
My theory is that the broader market just doesn't care about a single launch failure, but the algorithms are forced to react to the price drop anyway.
Well, that's a solid theory, and the actual mechanics of the RSI support that idea. A lot of retail traders assume that if a stock drops 20%, It must be oversold and due for a bounce.
That's what you think, right?
Right, but the RSI doesn't work on raw percentages. It measures the speed and the change of price movements. On a standard 14-day RSI, a stock isn't traditionally considered mathematically oversold until it dips below 30.
Ah, okay. So at 41.68, it still has plenty of room to fall before the algorithms even consider it a bargain.
Correct. It's decidedly bearish, but we are not in a panic level fire sale yet. Now, combine that reality with the neutral sentiment index. Remember, this stock ran up to nearly $130 in January. When a pre-revenue company rockets up to those fights, smart money almost universally anticipates a reality check.
They were expecting gravity to kick in.
Exactly. The neutral sentiment suggests that the broader market isn't actually terrified by this drop. Rather, it views the technical breakdown as the stock simply catching up to its actual valuation. The market was already waiting for an excuse to take profits, and the Blue Origin failure simply provided a convenient, highly visible catalyst to execute those sell orders.
That makes a lot of sense. And that dynamic where the market is just waiting for an excuse to reset the price mirrors, a much larger, much more intense debate happening on Wall Street right now. So let's get into the valuation debate. Is ASTS an undervalued gem, or is it a classic value trap?
If you want to see professional analysts completely contradict each other, this is the stock to look at.
It is entirely polarized. On one hand, you have the Yahoo Finance consensus, which is currently sitting at a strong buy. But then you look at major institutional players like Barclays, who have slapped an underweight rating on it with a punishing price target of just $65.
The spread is huge.
It's frankly absurd. The average target is around $86.40. The high target is $139, and the lowest target on the board is $41.20.
A nearly $100 spread between the high and low targets on an $80 stock is just a textbook indicator of radical uncertainty. The analysts literally have no idea how to price the future here.
Well, let's break down the bear argument first. The critics claim this stock is a pure value trap, overvalued by 50 to 80%. And the main piece of evidence they point to is that ASTS is trading at an eye-watering 250 times enterprise value to revenue.
Yeah, that number is going to scare a lot of people.
Now, for anyone listening who doesn't spend their day building financial models, break down why a 250x multiple is causing traditional analysts to break out in hives.
Sure. So enterprise value is essentially the total price tag of a company. It takes the market capitalization, adds the debt, and subtracts the cash on hand. If you divide that total price tag by the total revenue the company brings in, you get your EV to revenue multiple.
Okay, got it.
For a healthy, established tech company, you might see a multiple of 5, maybe 10.
Meaning investors are willing to pay $10 for every $1 of sales the company makes.
Exactly. So when AST SpaceMobile trades at 250 times EV to revenue, investors are paying $250 for every single dollar of sales. To a traditional value investor, that math doesn't just look expensive. It looks fundamentally detached from reality.
It sounds exactly like the dot-com bubble. You know, the era when analysts were valuing companies based on eyeballs and clicks instead of actual tangible profits.
It does feel a bit like that, yes.
But the bull argument says that traditional value investors are just missing the forest for the trees. The supporters believe ASTS is deeply undervalued because they're looking at the total addressable market, or TAM, which they peg at a staggering $1.75 trillion.
That's with a T.
Right. But I have to push back on this a bit. Isn't a multi-trillion-dollar TAM just a magic number that companies put on pitch decks to justify crazy valuations? It feels like a trap for retail investors hoping for a lottery ticket.
Well, the skepticism is completely warranted. And you are right that TAM is very often abused by startups. However, the reason traditional valuation metrics like EV to revenue completely break down here is because ASTS is attempting to be a true first mover in a sector that doesn't currently exist.
You mean space-based cellular broadband?
Right. Think about the mechanics of what they're trying to achieve. They aren't trying to build a slightly better smartphone app or a faster microchip. If their satellite constellation works as advertised, they effectively turn every existing standard mobile phone on Earth into a satellite phone.
No special hardware, no new antennas required.
None. Just seamless coverage anywhere on the globe.
So the 1.75 trillion TAM is literally just the entire global telecommunications market.
It is. And that creates a binary outcome for investors. For the bulls, looking at current revenue of $70 million is just entirely irrelevant. They're valuing the company based on the assumption that ASTS will capture even a fraction of a percent of a multi-trillion-dollar global telecom monopoly.
And if they capture that market share, today's $81 share price is going to look absurdly cheap in hindsight.
Unbelievably cheap.
But if they fail, or if the technology doesn't scale,
Then a 250x revenue multiple is grotesquely overvalued, and the stock goes to zero. It's either the greatest buy of the decade today, or it's a slow-motion train wreck. There is very little middle ground for a company attempting to rewire global communications.
so we have this incredible tension, a binary outcome where the stock either goes to the moon or crashes to zero. Let's move into our outlook and explore the specific risks that will determine which side of that coin lands face up.
Because the visionary ideas eventually have to meet operational execution.
Exactly. In the immediate short term, meaning the next few days and weeks, the outlook is extreme volatility. The entire market is collectively holding its breath for an official corporate update on the status of this Bluebird 7 satellite.
That update is going to be pivotal.
If management comes out and confirms the satellite is a total unrecoverable loss, a downward break below that $73.50 technical support level feels highly likely.
The market hates uncertainty, obviously, but it punishes confirmed bad news even harder. A confirmed total loss means we go right back to the fears of massive cash burn and shareholder dilution we discussed earlier.
Now let's zoom out and look at the long-term outlook. The bear case hinges on intense operational risks. Today's misfire is Exhibit A. Putting things in space is incredibly difficult, and the margins for error are microscopic.
Space is hard, as they say.
Yeah, we've talked about the threat of dilution, but maybe the biggest existential threat to this entire company is massive, well-funded competition, namely SpaceX's Starlink.
Starlink is the absolute apex predator in this ecosystem. I mean, they have their own dedicated launch capacity,
Sure.
practically limitless private capital, and a constellation that is expanding by the week.
Right.
If ASTS stumbles, Starlink is perfectly positioned to just absorb their prospective market share.
But the bull case is still remarkably resilient. The bulls argue that ASTS has a technological moat in this specific type of direct-to-standard cell broadband. And crucially, this is the most important data point for the bulls. ASTS currently has an 85% institutional float backing them.
That is massive.
The entire recovery scenario, the path to realizing that multi-trillion-dollar TAM, hinges on ASTS successfully launching 45 satellites by the end of 2026 to achieve full commercialization.
That 45 satellite milestone is the critical catalyst. Without it, the network just doesn't function at scale.
But I want to linger on that institutional float number because it completely changes how we should interpret today's panic. If 85% of the tradable shares are held by institutions, that means the big money like the mutual funds, the state pensions, the massive hedge funds, they are already in the room. They control the vast majority of the supply.
And institutional capital moves very differently than retail capital.
Right. If I'm an institution holding millions of shares, I'm not panic selling my position because of one bad headline on a Tuesday morning. I have analysts who spent months modeling this risk. So if the institutions are holding firm, it means they still believe in the long-term thesis.
That is the stabilizing factor here. If we connect the dots, that 85% institutional float is effectively acting as the floor, keeping the stock from totally collapsing today.
Right. Their presence provides a baseline of stability because they are absorbing the short-term shocks.
They are acting as the shock absorbers for the retail panic.
Yeah.
Yes. However, we cannot ignore the ceiling.
The operational risk?
Exactly. That immense operational risk, the sheer gravitational reality of needing 45 flawless rocket launches and delicate orbital deployments by the end of the year, that is the ceiling, keeping the stock highly volatile. Every single launch is a roll of the dice.
Wow.
The floor is solid because of the institutional money, but the ceiling is heavy because rocket science is notoriously unforgiving.
It really is the ultimate high-stakes balancing act. Okay, let's briefly recap this wild ride we've been on today. We're looking at a stock that took a vicious intraday hit on a high-profile launch failure. We explored a balance sheet that has a massive fuel tank of working capital, but is bleeding hundreds of millions in net losses to build out a revolutionary technology.
It's burning cash to buy time.
Yeah. We've got short-term technicals flashing sell, contrasted against a Wall Street ecosystem that is completely torn between a $41 low and a $130 high price target. It is the absolute definition of a battleground stock.
It is a phenomenal case study in how modern markets struggle to price revolutionary potential when it clashes with immediate, messy operational realities.
And that brings us to our final thought, something for you to mull over as you watch the ticker over the coming days. We just established that 85% of ASTS shares are locked up by strong-handed long-term institutional backers. That leaves only 15% of the float available for everyday retail trading.
It's a tiny slice of the pie.
Right. So, with all the heavy volume and downward price action we saw today, who exactly is doing all the selling? Are the smart money institutions using the cover of this bad news to quietly liquidate their massive positions? Or are retail traders simply churning that tiny 15% sliver of the market, spooking themselves into giving up their shares at a massive discount?
That is the central mystery going forward. Paying close attention to the volume and the upcoming institutional filing disclosures will tell you exactly who blinked first in this staring contest.
Well said. Thank you for joining us on this deep dive into the mechanics and the madness of AST SpaceMobile. Keep questioning the data, always look past the headlines, and remember that our exploration today was purely an analysis of the market, not financial advice. We will see you next time.